St. Louis Fed President James Bullard, speaking in Little Rock, Arkansas, says the Fed will miss its inflation target in 2019 and over the next 5 years, according to Bullard. He says a further global growth slowdown is possible, tangible is the word he used, and the sustained yield curve inversion is indeed sending a bearish signal for the U.S. economy. Most importantly, he says the market is signaling the Fed may be overly hawkish, and says the Fed should moderate its normalization campaign. This is in line with what he's been saying, but maybe a little bit further than where he had been before. And I've got a way of illustrating where these guys are.
He's been a dove for a long time, though, right? I mean, you're saying he's even more dovish?
That's right. Well, projecting out 5 years on his inflation target, and then a little bit countering what's been out there in terms of the way the Fed looks at the yield curve and the way others do. So this shows what's happened in the last couple of days, guys. Everybody who has spoken has moved into the neutral circle, right? Nobody is, we should hike now. Nobody is, we should cut now. But they've all moved into neutral. And the only thing I'm trying to illustrate with this is that there are people who are different sides of this circle. You've got guys like Bostic and Bullard that are, we're neutral now, we're wait and see, but we really think we're probably going to be cutting. And then you've got guys like Evans and Rosengren, who are like, Rosengren, in fact, I don't know if you guys made a big deal of him yesterday, but he said, the market's going to be wrong here. I'm going to be right, not me, as in me, but me as in Rosengren.
We got that.
Make sure you got that right. That the data will prove to be right, that the economy will do better than the markets believe. And he says, and Evans also said he thinks, if you had to guess right now, 3 hikes is what he's going to do.
So interesting. One of the things that caught me about the Bullard thing, the market speaking loudly that the Fed was too hawkish.
Right.
And then also wondering, sentiment, consumer-wise and just economic-wise, seems like things kind of fell off a cliff in December. And maybe that was related directly to the stock market's pullback. Macy's is a good example of that.
Right.
CEO was on this network at the end of November saying the holiday season is going to be fantastic.
Right.
He was as optimistic as any CEO who had come on the network at that period of time. And then they come out today and drop the kind of negative bomb that they did. It just seemed like the market had maybe a bigger impact on overall activity and sentiment than maybe the Fed thought initially. And now they've come back towards that point of view.
I think so. I think they are not ignoring the market signals here. I think they do not see the market signals as absolute proof of what's going to happen.
Fair.
Because one of the things that's happened to these sentiment surveys that gives economists pause, Scott, is they have fallen, and in some cases sharply, but to still pretty strong levels. I'll give you an example. The ISM was one of the biggest falls we've seen in a while, down to 54. It's still consistent with 3% growth. The services fell from 60 to 57, still consistent with very strong growth. We still have not seen the hard data that proves that this really fearful slowdown is happening. And by the way, we may not see it because of the government shutdown.
Steve, I'll make 2 points, though. 2 points. It's not where the data point is today. It's where the market sees it's going.
Right.
It's a discounting mechanism. However, what you're describing in 2 words, Goldilocks scenario. You've got a Fed that's on hold, possibly easing, while you're still having slightly above trend or trend growth, and that's great for the markets.
Right. Part of my point to you as well was it seemed that the Fed was somewhat dismissive of the market pullback, at least in the earlier stages of it, and now has come around, and maybe the market was actually getting something that perhaps we were missing. Now, they didn't say it in those words, but, and let me just point out, there's David Rubenstein right there. The Fed chair is right there walking with a cup of coffee in his hand. There's Jerome Powell. They're going to sit down for a Q&A
next minute,
which is going to be interesting.
You want the Fed, though, to be
these recent comments that
you want the Fed to be dismissive of some market movements, right? You don't want it to change policy. For example, the market was, I think, way to put it, dead wrong on October 3rd when it hit an all-time high, wasn't it? So you wouldn't have wanted the Fed to react to that. Now, it needs to be late. Maybe it was too late. Maybe I think the other thing you're getting at, Scott, is maybe they had a tin ear to some of what was going on out there.
We're listening to our models rather than the markets. And now it seems to me that they've put everything together. They said, okay, maybe the markets have spoken loudly enough that we need to pay attention to some of the stuff that was going on.
I think that's right, but I wouldn't sort of sound the all-clear signal because I believe if the economy is high, if you go back to that thing, I think guys like Evans and Rosengren may end up not being 100% right, but they may be 70% right.
So
you may get one or 2 hikes.
You'll never get the pause in the balance sheet, which is what the market is looking for.